Good morning, guys. In today's video, I'm going to be doing a discounted cash flow model on Apple stock. Apple stock closed the last trading day, Friday, November 8th, at $260.14. Discounted cash flow models are a good way to get a sense of kind of the valuation of where a stock stands at any given point. Now, the way the discounted cash flow models, the theory is that a stock's worth is dependent on the total sum of the discounted cash flows, because a dollar today could be invested in the market, right? So a dollar today will be worth more than it is, say, 5-10 years from now. Because you could take that and invest it, say, in a stock or a bond and get a return on that. So to discount it back, we've got to find the present value of all the future cash flows. This is a great way. Warren Buffett, a lot of the value investors, Benjamin Graham, use this theory of thought that, hey, a stock is worth, the earnings power and the cash flows that it generates. So in this example, I'm going to take Apple. This is one of the most followed stocks. Has over $1 trillion market cap, and we'll kind of see, see where the valuation is right now, dependent on its current cash flows. So as of the last trailing 12 months in 2019, you can see there at the top the free cash flow. So what is free cash flow? That is the total cash flow that's coming into a business. Some people call it owner's earnings. That's what Warren Buffett calls it. It's essentially the operating cash flow of the business. It's a sum of the cash inflows and the cash outflows. And then you subtract the capital expenditures, because any business, has to maintain its business, invest in, property, plant, equipment, to buy assets that will increase the earning power of a stock. So if we take a look there at the top, this is an average. And again, this model really works best for companies that have a consistent, free cash flow generation. So, these are companies, think of Coca-Cola, Apple, maybe Johnson & Johnson, Nike, Microsoft. A lot of these are going to be these Dow companies. They're mature companies that, have a consistent track record of generating, cash flows, free cash flows. So in this example, I'm going to take, this is a very conservative example. You see under that 58 billion that this is the average of the last 3 years that Apple has generated in free cash flow. The growth rate is 3%. Now, 3% that's the level historically, the consumer price index, which is a general, level of where, market values are over a given period. It can also be tied to, say, the inflation levels. Inflation has historically been in that 2.25% to 3%. So it's a good way to use a conservative growth method. Now, with Apple, some of these high growth tech stocks, you can use higher growth rates, depending on kind of what you think, or what an analyst thinks that a stock will grow at. The terminal growth rate, that is essentially, for any discounted cash flow model, that is the long-term growth rate. So again, in this model I use 2% just because that's kind of been historically, if you look back over a long period of time, 2% has been the kind of general, inflation level. If you just have money sitting in cash over time, it'll lose about 2% per year. The discount rate, that is the rate at which we discount all the cash flows, because again, a dollar today is not worth as much, or it's worth more than it will be in the future, because we could take the cash today and invest it, say, in a stock index and make, say, 5, 6, 7, 8, 9%. Okay, now I use 9% as the discount rate in this model because historically, if you look at the S&P 500 and stock market returns, it's been in that 8 to 9% range before inflation. The cap rate there is 4%, and what the cap rate is, again, you can use a couple different methods here. You can use a dividend yield. In this example, I used kind of the average over the last 4 or 5 years. The long-term corporate bond yield, in this example, I use 4% right now. A 20 to 30-year corporate bond is in that 3.5 to 4%. I just assumed 4% for round numbers in this example. So if we go in here, you start with 2019. If we assume Apple's going to generate about 58 billion, and then you project that over the next 10 years, this model goes up to 2029, and then you can see on the top line that's the nominal free cash flows. In that second line there, discounted FCF, that is discounted free cash flows. That is all the discounted cash flows, okay? So the present value of all the future cash flows there in that second line goes out. I ran this model out to 2029, and then you can see there FCFY11, that is future cash flows projected. I get on a nominal basis in year 11, and then you take that, you divide it by the cap rate, which is again the corporate bond yield. You can use a dividend yield to get the projected market value. In this example of Apple, the projected market value in the year 2030, which in this example, I say that, hey, in 11 years, say, by 2030, Apple could be worth, about double what it is now, almost $2 trillion. In this example, $1.98 trillion. If we discount that future valuation back to the present, you see you get that present value of the enterprise value, which is 770 billion, and then you add to that the sum of all the discounted cash flows. So in this case, I'm assuming that the discounted value of Apple's projected total market cap is going to be 770 billion. You add that to the discounted cash flows, the present value of all the discounted cash flows, which in this case is about 430 billion. I'm going to assume that fair market value of Apple stock at the moment is about 1.2 trillion. Apple has about 4.5 billion shares outstanding. So if you take that 1.2 trillion, divide it by the 4.5 billion shares that Apple has outstanding, we get an implied valuation for Apple stock based on all the discounted cash flows of about $265. So we can see that based on the current closing price of $260.14 on Friday, November 18th, this discounted cash flow model would lead you to believe that Apple stock at the moment is fairly valued. The market is pricing it in right now the market is telling you based on current valuations that they're projecting Apple stock to grow their cash flows at about 3% per year. And, you know, so given the current price, based on this discounted cash flow model, there's right now probably about 2% upside in Apple stock. So if we look at it, if we're considering an investment in Apple stock or any other stock that you are, interested in right now, we can see it's fairly valued. There's probably not a lot of long-term upside at the moment in Apple stock. Now, the other thing to remember, anytime you're running a discounted cash flow model, this is for a long-term buy and hold investor. This isn't, a short run projection, anything like that. This is for the investor. It could be a value or a growth investor that's looking from a fundamental standpoint, looking at the quality of the business, the quality of the cash flows, the earning power that it has, the sustainability. So these are companies that you want to say, hey, this company has a really, really good chance to hold its market position for the next 10, 20 years. Otherwise, this model doesn't do a great job. It's not as effective, say, for a company that has an inconsistent track record of generating these cash flows, right? A more speculative stock, a small cap, a growth stock, something like that, where there's a lot of volatility in the earnings. Say one year they report really good earnings, and the next year, there's a big loss in, say, the operating or the free cash flows. So in these models, we want to use, again, a company that has a consistent track record of generating free cash flows. I think this discounted cash flow model does an excellent job of showing an investor or an analyst where a stock is trading at any given time. So if I'm looking at making an investment in Apple stock at the current valuations, I'm not probably going to invest right at this time, just because it seems like at current valuations, Apple stock is pretty fairly valued. It doesn't seem like there's a lot of long-term upside. Okay, now another thing to remember in this is that these discounted cash flow models can be based on the growth rates, the discount rate that you use. It can be, that's one of the downsides of a discounted cash flow model, is these valuations can be pretty dependent on the growth assumptions that you use and the growth figures that you use. So I always like to use, for a company like an Apple, a Coke, think of any of these Dow stocks, I use a very conservative metric, being the growth rate around 3%. You use a terminal growth rate, a long-term growth rate of anywhere from 0 to 3%, and then I always like to use a discount rate of kind of the general annual appreciation of, say, the S&P 500 index, the annual returns of a stock index. And again, the cap rate, I like to use the long-term corporate bond yield. So to sum it up, if I'm looking at a stock, say, and I say in this example, Apple right now, based on the free cash flow and growth assumptions, is fair market value, or a target value is 265, say, I'm going to want to find a stock, if I'm a value investor, that's where there's maybe 50% upside, something like that. So in this case, I wouldn't classify Apple as a buy until it fell somewhere in the range of, say, $180, $200. Then you can see, okay, if I'm assuming this example, if the discounted cash flows of Apple stock would say that there's an implied equity value of 265, then, you know, if I can get into that stock, say Apple were to fall in the next year or two down into that, you know, below 200, that would be a really a good buy, because we're buying it at a discount to the discounted cash flow valuation. So in a future video, I'm going to show viewers how to build one of these. It's not too difficult once you kind of understand how, you know, these discounted cash flow models work. This is a really good way. It's a common way for analysts to value a stock. But again, it needs to be a stock that has a consistent track record of generating positive future cash flows. So I hope this helps you guys. Thanks for watching, and we'll see you on the next video.